We have just crossed a line that most investors never believed they would see in their lifetime. For years, any warnings about the silver market were dismissed as nothing more than conspiracy theories, exaggeration, or fear-mongering. But today, the market delivered a message that simply cannot be ignored. This was not a rally. This was not excitement. This was a forced liquidation event that exposed deep, deep cracks inside the global financial system. When silver surged violently in a single trading session, it wasn't enthusiasm driving prices higher. It was panic, margin calls, and the sudden catastrophic collapse of entities that were never supposed to fail. A move of this magnitude just does not happen in a functioning market. Commodities do not jump by double digits in a single day under normal conditions. When they do, it signals that something is breaking behind the scenes. Somewhere in the system, a massive player was pushed past the point of survival. Their positions were not closed calmly. They were ripped out of the market by force. Algorithms took control, positions were liquidated at any available price, and the order book was consumed in mere seconds. That is why the chart went vertical. And that vertical line isn't optimism. It is the financial equivalent of an explosion. This is what forced buying looks like. In a healthy market, buyers and sellers negotiate. Prices move gradually as supply meets demand. But during a forced liquidation, negotiation disappears. The clearing system steps in and executes one command only: close everything, immediately. Price becomes irrelevant. The system buys at any level because survival is the only goal. And when this happens during a period of thin liquidity, prices don't just climb, they teleport. That is exactly what we just witnessed. What makes this moment even more alarming is the broader context. Gold, the anchor of the monetary system, has already shattered levels once considered impossible. When gold breaks through major psychological barriers and holds them, it validates everything that is happening in the silver market. Historically, silver lags gold, and then it violently catches up. That catch-up phase is where the most extreme moves always occur. And even after this explosive jump, silver remains deeply undervalued relative to gold by historical standards. That imbalance isn't a warning sign, it's fuel. This is not just a metal story. This is a currency story. When investors lose confidence in paper money, they don't ask for better yields. They demand an escape. They rush into assets that cannot be printed, frozen, or digitally erased. Silver isn't moving higher just because it's scarce. It's moving higher because trust in the very system used to price it is collapsing in real time. Every vertical candle on that chart is a vote of no confidence in fiat currency. The timing of this event makes it even more dangerous. The markets are closed for the weekend, but fear is not. Right now, risk managers, banks, and hedge funds are running emergency calculations. They are stress testing their balance sheets against price levels they never even modeled for. Some of them will discover they cannot survive the next market open. That fear doesn't just disappear when markets reopen on Monday. It compounds. It drives even more desperate buying and attracts even fewer sellers. Meanwhile, the physical market is sending warning signals that paper traders cannot ignore. Dealers are pulling inventory, removing prices from their websites, and switching to manual order confirmations. This only happens when volatility overwhelms their systems and supply becomes uncertain. When you can no longer buy metal at the posted price itself has failed. That disconnect between the screen price and the street price is the textbook definition of a currency crisis. As we approach the next market open, the risk of exchange halts grows significantly. Futures markets have built-in circuit breakers designed to slow down a panic, but they often have the opposite effect. When prices rise too fast and trading is frozen, short sellers are trapped. They cannot exit. Their losses grow automatically. When the market finally reopens, the buying pressure intensifies because everyone rushes to escape at once. This feedback loop can lock a market limit up for multiple sessions, creating conditions where price discovery becomes violent and uncontrollable. This environment is lethal for anyone using leverage. Wild swings are no longer the exception, they are the new normal. A move of several dollars in just minutes becomes possible. Those using borrowed money might be correct about the direction but could still lose everything. In moments like this, ownership matters more than speculation. Physical assets remove counterparty risk. Paper promises multiply it. And institutional money is watching very closely. Funds that plan to enter the market later are now panicking as the price runs away from their models. History shows that large institutions don't buy low, they buy strength. Momentum attracts capital, not caution. As new allocation cycles begin, massive pools of money will be forced into a market that is already broken. That is how shortages turn into manias. Behind the scenes, industrial buyers are reacting even faster. Companies that rely on silver for manufacturing cannot afford supply interruptions. When volatility explodes, suppliers hesitate, contracts are questioned, and deliveries are delayed. This forces manufacturers directly into the spot markets, bidding against investors for real, physical metal. Industrial demand doesn't care about price, it cares about availability. That makes it one of the most powerful drivers in any commodity crisis. At the same time, the clearinghouses are under extreme pressure. They are designed to handle routine volatility, not historic spikes. When a major participant fails to meet margin requirements, the losses don't just disappear, they spread. Other members are forced to cover the gap, liquidity dries up. Trust evaporates. This is how isolated trades become systemic events. One failure weakens the entire structure. The public has finally noticed. Search interest for silver is surging. Retail investors often move late, but when they move emotionally. They don't wait for pullbacks. They buy momentum. Their orders are already queued up, waiting for the next market open. When those orders hit a market with limited supply and terrified sellers, price gaps become inevitable. Psychology now plays a critical role. Crossing major price levels changes behavior instantly. What once felt expensive suddenly feels inevitable. Media narratives shift. Skepticism turns into fascination. And fascination turns into a fear of missing out. That transition fuels the final, explosive stages of a move. Despite the chaos, this is not the end. This is the beginning of price discovery. Suppression doesn't end quietly. It ends violently. What we are witnessing is the release of decades of pressure in a system built on leverage, confidence, and belief. Once that belief breaks, the math takes over. For those of you watching this unfold, the most important task is to maintain emotional discipline. The volatility will be extreme. The headlines will be loud. The so-called experts will argue. But the price action is the truth. It reflects decisions made under incredible stress by the largest players in the world. And right now, those decisions all point in one direction. This weekend represents a pause, not a resolution. When the markets reopen, the battle resumes. Gaps, halts, and violent swings should be expected. These are not signs of failure, they are signs that the system is being forced to reprice reality. History will look back on this moment as a major turning point. The moment when paper certainty collided with physical limits. The moment when confidence broke faster than any model could adapt. And the moment when silver stopped behaving like a commodity and started behaving like money again. The game has changed, true price discovery has begun. And once it starts, it does not move slowly. Thanks for watching and be sure to subscribe for more updates as this situation develops. Stay safe out there.